So now that we know what the tools of monetary policy are, let's put them together to say their effect when used for easy money policy. So, open market operations. The government buys back the bonds, then the reserve ratio falls, the discount rate falls. The reserve ratio falls, leakages fall. This means all of this combined together leads to credit creation, while the credit multiplier also increase because of less leakages. So this leads to, let me use a different color for this. This leads to a rise in the money supply and a fall in interest rates. So first, interest rates fall, consumption rises because saving is unattractive and borrowing is easier. Then, if you take a look at investments, investments rise as well because marginal efficiency of capital is inversely related to interest rates. Interest rates falls, MEC rises, investment rises. Government expenditure. Government expenditure is not affected at all. Then finally, net exports. Interest rates fall. It is cheaper to purchase imported raw materials, which means that the cost of production falls. Cost of productions fall, exports rise, because this means that the price of exports falls, which means that they are now competitive in the world market as compared to goods of other countries. And this means that your imports will fall as well because the cost of productions fall. This means that your local goods are cheaper, so local consumers will also prefer local goods as compared to imported goods. So net exports rise as well. Plus, with a fall in interest rates, there will be hot capital outflow. So if there is hot capital outflow, the demand for local currency, let's say rupees, falls. The demand for rupee falls. This implies that the price for rupee falls. Your currency depreciates. Again, when currency depreciates, exports rise, imports fall. I'm assuming that you know why this happens from AS knowledge. So, if you take a look at the entire aggregate expenditure function, this is C plus I plus G and finally plus X minus M. So the overall impact will be a rise in consumption, a rise in investments, nothing for government expenditure, and a rise for net exports. This implies that AE rises and your national income rises by change in AE times the multiplier. Therefore, easy money policy is a counter-recessionary policy, as we can say that consumption rises, investment rises, net exports rises, causing an overall increase in aggregate expenditure, leading to a rise in equilibrium income by the change in AE times the multiplier. Take a look at the transmission mechanism. let's quickly draw three curves. So this is one curve. Over here, the LP curve and the money supply. This is quantity of money and this is interest rates. Then we have the marginal efficiency of capital with investment over here, interest rates over here, and then finally, to show the equilibrium income, withdrawals and injections. So this will be withdrawals. Let's say this is injections. So money supply shifts to the right. Let's call this MS1. This leads to a new interest rate. Let's call this R1. This R1 carried forward to over here. Let's extend this a little. This is your new investment, I1, and this leads to a rise in equilibrium income. Let's call this Y1. Let's call this I1 equals to J. That's injections. However, the rise in equilibrium income will lead to a rise in the demand for money, right? So let's use a different color to show this. This means that the liquidity preference curve will slightly rise. So if liquidity preference curve slightly rises, this will increase the interest rates a little. So the new interest rate will actually be this one, right? And if that's the case, investments will fall a little because of a partially rise in interest rates due to an increase in liquidity preference curve, due to an outward shift of liquidity preference curve. So this is one limitation of easy money policy, the crowding out effect, that because of an increase in equilibrium income, the demand for money rose, and because of the rise in the demand for money, interest rates rose and partially reduced the effect in the fall of interest rates of easy money policy. If we go in details of why the demand for money increases, because of a rise in equilibrium income, the demand for the transactionary motive rises, for the precautionary demand for money rises, and because interest rates fall, the price of bonds rise, and when prices rise, we know that demand for bonds fall. When the demand for bonds fall, the demand for speculative demand for money rises. So which is why S also rises, leading to an overall outward shift in liquidity preference curve. So this is a limitation of easy money policy, the crowding out effect. So in the next video we'll talk about tight money policy and how all these three tools come together to impact the money supply and interest rates when the central bank applies a tight money policy.